Welcome to This Explainer. Today, we're going to unpack a totally fascinating real-world investing story. It's one that proves both mathematically and honestly, behaviorally, why a super simple, completely passive strategy actually crushes active stock picking over the long run. So if you've ever found yourself wondering if all that stress of glued to the screen market tracking is actually worth it, well, you're going to want to stick around for this. Okay, let's dive right into this by setting up a little scenario. Imagine two investors standing at the exact same starting line of a 30-year race. We're going to see who actually comes out on top here, the active, highly engaged stock picker or the quote-unquote lazy investor who literally just puts their entire portfolio on autopilot.
Meet Grace and Tyler. They're both 30 years old, they both have a starting nest egg of $25,000, and they're both committing to investing exactly $500 every single month. So they have the exact same salary, the exact same contributions. We're basically setting up a perfect scientific control here to test two totally different investing strategies head-to-head.
Let's take a look at Grace first. Grace opts for ultimate simplicity. She buys one boring, low-cost index fund. Now, if you're not familiar, this is just a single investment that buys you a tiny sliver of thousands of companies all at once. Grace automates her $500 monthly deposit, and then she does something that feels completely irresponsible to a lot of hardcore finance gurus. She stops looking at it entirely. She ignores the news, she doesn't check her phone during lunch breaks, she just lets it sit there. Tyler, on the other hand, wants to beat the market. I mean, who doesn't, right? He puts in the hard work. He's reading the annual reports, he's listening in on earnings calls, and he meticulously builds this concentrated portfolio of about 8 to 12 companies that he genuinely believes in. Tyler isn't gambling here. He is doing the heavy homework that frankly most people are just too lazy to do. But here is the short-term reality check. By year 3, Tyler is winning. 2 of his handpicked stocks went on an absolute tear, and his portfolio is sitting pretty at $63,000. Meanwhile, Grace's passive, boring index fund, it's only at $54,000. If you asked anyone on the street right now who the better investor is, they'd say Tyler, hands down. Stock picking absolutely can work in the short term, and this early taste of success usually makes people believe they have some sort of permanent edge. But Tyler is actually fighting some pretty terrifying statistical odds. Check this out. Since 1926, an astonishing 58% of all individual U.S. stocks failed to even beat a one-month treasury bill over their entire lifetimes. Let that sink in. He's reaching into a massive pool where more than half the companies eventually turn out to be complete duds, and he's just hoping he has the magic touch to consistently pick the winners. The crucial point here is captured perfectly by Vanguard founder John C. Bogle, who famously said, "Don't look for the needle, buy the haystack." You see, historically, all of the net wealth created by the entire stock market came from just 4% of companies. Finding those few needles is incredibly hard. But Grace's strategy? By buying the whole haystack through her index fund, she absolutely guarantees that she automatically owns those explosive 4% of winners. Fast forward to year 10, and look at what happens. The lead totally flips. Grace is now sitting on roughly $167,000, while the quote-unquote genius of year 3, Tyler, is trailing behind at $150,000. He's actively losing to someone who literally hasn't logged into her brokerage account in a decade. So what happened? How did this fall apart for him? Well, 2 massive things derailed Tyler. The first is what financial analysts call unsystematic risk, which is just a fancy way of saying the unique danger tied to one specific company. Think management scandals or massive product recalls. Tyler got hit hard by this when one of his highest conviction stock picks suffered a catastrophic year, tanked 70%, and just never recovered. Because he only held about 12 stocks, that one single loser wiped out years of his hard-earned outperformance. The second major drag on Tyler is sort of the silent penalty of being active: taxes. Every single time Tyler successfully sold a winning stock to lock in a profit, boom, he triggered a capital gains tax bill. He was constantly slicing off pieces of his compounding power and handing it right over to the IRS. Grace, meanwhile, she hasn't sold a thing. Her money is just compounding away, totally untouched by taxes. And this brings us to a fundamental truth in investing: the behavior gap. Holding 12 individual stocks gave Tyler 12 separate reasons to panic, to sweat over scary news headlines, and to make an emotional, knee-jerk decision at the exact worst possible moment. When one of his stocks drops 50%, his finger is hovering right over that sell button. An index fund, on the other hand, gives you virtually nothing to obsess over or panic sell. Actually, Grace's index fund operates like this brilliant, self-cleaning autopilot. When a company starts failing, its share price drops, right? So it naturally shrinks its footprint inside the index. But when a company wins and grows, the index automatically holds more of it. She's just writing her winners and burying her losers completely on autopilot, with zero stressful, real-time decisions required on our end. All of this sets the stage for what gets called the eighth wonder of the world: compound interest. It's basically just interest calculated on both your initial money and all the accumulated interest from the past. Over a timeline of decades, this mathematical engine violently rewards whoever can maintain a higher rate of return, steadily, without interrupting it. So, let's look at the final 30-year scoreboard. Grace managed to capture the market's long-run average, which sits right around 10% annually. Tyler, despite all of his blood, sweat, and tears, averaged closer to 7% a year. His trading costs, those pesky tax bills, and his inevitable human emotional mistakes just dragged his long-term average down compared to Grace's pure market return. Now, a 3 percentage point difference might sound like a rounding error, but when you run that through the compounding machine for 30 uninterrupted years, the results are just staggering. Grace's simple, lazy index fund strategy has exploded into an unbelievable $1.55 million. And Tyler, well, he ends up with roughly $800,000. Think about that. He did hundreds of hours of deep research, he took on way more risk, he dealt with constant stress monitoring his portfolio, and at the absolute end of the race, he has barely half of Grace's wealth. This highlights an incredibly empowering takeaway from all of this. If you are a student or a young investor just starting out, your greatest asset isn't financial genius. It's not finding the next massive tech unicorn. Your absolute greatest asset is simply the amount of time you let your money sit in the market. The longer your runway, the more compound interest does the heavy lifting for you. So if you want to replicate Grace's success, here is a totally foolproof beginner strategy based on everything we've looked at today. Step 1. Open a zero-balance, low-cost brokerage account. Definitely avoid those expensive full-service brokers. Step 2. Buy a broad index fund. Step 3, set up an automated monthly deposit so you don't even have to rely on willpower. And step 4, the hardest part, ignore the noise. Just don't look at it. Now, if you're sitting there thinking, okay, but I really want to pick stocks, it's fun. Hey, that is totally fine. But experts usually recommend what's called the core and satellite strategy. You keep the vast majority of your money, your core, securely anchored in those boring, broad index funds. Then you use a tiny, separate satellite portion of your portfolio to scratch that itch and buy individual stocks. That way, if your picks totally fail, your financial future is still perfectly safe. Ultimately, your wealth is built by your behavior, not by your intelligence. So I really want to leave you with this question to ponder today. When your single biggest stock pick drops 50% in a single month, are you actually going to have the nerve to hold on? Or will you wish you had just bought the index, closed your laptop, and gone for a walk outside? Ask yourself honestly if you are truly equipped to beat a system that already does all the hard work for you. Thanks for joining me for this explainer, and I'll catch you in the next one.